details that we require as a trader. Let me explain. Sometimes when seeing a lot of details on a chart, it can lead to a more enhanced and refined interpretation of what is happening in the chart. But there are other times when seeing too much detail is equivalent to seeing nothing at all. Take a look at this chart. It is a lion chart. It looks fairly easy to interpret as there are only two major movements taking place. There is a sharp uptrend and a longer downtrend. We could say that there is very little information available because line charts erase open, high and low points as it only considers the closing prices, and in addition to that, it erases any trading gaps that might have occurred. So this chart may be filtering out some crucial information that might be critical to a trader's decision-making process. Now, if you had to trade using this chart, it would be very difficult to get a deeper insight into the market sentiment, and it will be nearly impossible to set detailed entry or exit processes based on support, resistance, and retracements. Now, let's pull up a traditional candlestick chart in order to see this price action in much greater detail. Now you can see the open, high, low, and close prices of each trading session. You can clearly see which days were bullish and which were bearish. You can even see the price gaps. From this point of view, it is also easy to see the general market trends. And if you are someone who simply follows the swing highs and swing lows, then it might be relatively easy to follow the trend. I even agree to the point that these traditional candlesticks are great at helping you find good entry points since they display potential reversals using pin bar candles like hammers or shooting stars, or display breakouts using strong candles like a bullish or bearish Marubozu, which closes above a resistance level or below a support level respectively. But what about once you are in a trade? Imagine having to make trend-based decisions after each candle. When a bullish candle is followed by a bearish candle which is followed by another indecision candle, there will be a lot of emotions in play. There will be highs and there will be lows, and it will be like riding a roller coaster. This is where applying the Heikin-Ashi technique to a price chart can help you decide whether to stay in a trade or get out. It is as simple as that. Heikin-Ashi charts make candlestick charts more readable for traders who want to know when to stay in a trade and ride a strong trend, and when to get out when the trend weakens. So basically, Heikin-Ashi is a modified candlestick chart technique that rearranges how the price is displayed so that the trend traders can have a higher confidence level when deciding whether to remain in a trade or exit their positions. Now, talking about details, it has a lot more detail than a line chart, though not as much detail as a candlestick chart. But in terms of trend analysis, it has a lot more clarity than traditional candlestick chart, though not as much clarity as a line chart. Now, having understood why we need to consider Heikin-Ashi, we are ready to take a look at what Heikin-Ashi is. Starting from the grassroots level, the Heikin-Ashi trading technique was developed in 1700s by Munehisa Homa, a rice merchant from Sakata, Japan, who is considered to be the father of candlestick charts also. So in Japanese, Heikin means average and Ashi means pace. Clubbing together, Heikin-Ashi represents the average pace of prices. So if you are new to the market, the Heikin-Ashi chart will look similar to the traditional Japanese candlestick charts, but it's not the same. Each Heikin-Ashi candlestick has a body and an upper or lower shadow or wick. But trust me, there is a big difference between the two types of candlestick charts. You can't just use Heikin-Ashi candlesticks like normal candlesticks. Most bullish or bearish candlestick patterns that you find in normal candlesticks are sometimes not found in Heikin-Ashi. We will discuss why this will happen in a short while. This Heikin-Ashi charting technique is used to help filter market noise. In addition to that, these candlesticks can be used to identify trending periods in the market, identify potential reversal points, and it can even spot classic technical analysis chart patterns with much ease. Now you may have a question running in your mind. How is Heikin-Ashi different from a typical candlestick? In order to understand this better, let's put up both these charts side by side. The chart on the left is traditional Japanese candlestick chart, and the chart on the right is Heikin-Ashi chart. And as you can see from the chart on the right, the Heikin-Ashi chart has smooth directional price moves with more successive bars of the same color, which gives a clearer picture of the price movements. But the traditional candlestick chart changes colors frequently from green to red and vice versa, making it difficult for traders to interpret and identify trends. You'll notice that Heikin-Ashi charts have a tendency for its candles to stay green during an uptrend and red during a downtrend. This is in contrast to the traditional candlesticks that alternate color even if the price is moving strongly in one direction. And also, you can clearly see that Heikin-Ashi chart is much more smoother looking in terms of price action, as it reduces the noise on the chart and it displays consecutive colored candles, making it much easier to interpret and identify prior price movements and current trends. Now, this is the reason why usually long-term traders use Heikin-Ashi charts as an alternative to traditional Japanese candlestick charts, while other short-term and intraday traders use them in conjunction with traditional Japanese charts, switching back and forth between the two. Another factor that makes Heikin-Ashi different from traditional Japanese chart is how the price is displayed in terms of open and the close. Now, if you look closely at the Heikin-Ashi chart, you'll notice that each of the Heikin-Ashi candlesticks start from the middle of the candlestick before it, and not from the level where the previous candlestick has closed. Now, Heikin-Ashi candles act this way due to the way in which they are calculated. So, it is a no-brainer that we need to learn how to calculate Heikin-Ashi candles in order to unveil a lot more of its secrets. With the traditional Japanese candlestick charts, each candle represents the open, high, low and close that the price makes within the current time period. This time period can be 1 minute or 10 minutes or 1 hour or any of them. But that's not the case with Heikin-Ashi candles. With Heikin-Ashi candlestick charts, each candle doesn't just include the price movement within the current time period, it also includes the price information from the past. Now, let's look at how this is done. Just like a regular candlestick, each Heikin-Ashi candle has a open, close, high and low, except that the open and close are calculated differently. This means that there are 4 parts of the Heikin-Ashi formula. The open of a Heikin-Ashi candlestick equals to the midpoint of the previous candle, which means the Heikin-Ashi open price is equal to the open of the previous bar plus close of the previous bar, the whole divided by 2. Now, this answers our question, and this is the reason why you'll notice that every new candlestick starts from the middle of the previous one. Now, talking about the high price of a Heikin-Ashi candlestick, it takes the actual high of the current period. This could be the highest shadow, the open or the close, whichever is the highest. Now, the low price of the Heikin-Ashi candlestick takes the actual low of the current period. So, this could be the lowest shadow, the open or the close, whichever is the lowest. Finally, the close of each Heikin-Ashi candlestick equals the average value between the 4 parameters, that is open, close, high and low for the current price bar. So, Heikin-Ashi close price is equal to open plus high plus low plus close, the whole divided by 4. These calculations are really simple. But here we have a chicken and egg dilemma. Which came first, the chicken or the egg? Remember the fact that we need the previous candle for current candle calculation. So, we need our first Heikin-Ashi candlestick before we can calculate the future Heikin-Ashi candlesticks. It has to start somewhere, right? Therefore, the first calculation simply uses the data from the current open, high, low and close. So, the first Heikin-Ashi close equals the average of the open, high, low and close, and the first Heikin-Ashi open price equals to the average of the open and close price. The high and low prices of the Heikin-Ashi candle is the high and low of the current candle itself. Now, even though this first Heikin-Ashi candle is somewhat artificial, the effects will dissipate over time, usually within 7 to 10 periods. Now, the general idea behind Heikin-Ashi candlestick is that they smooth price action. Much of the market noise as displayed by the traditional Japanese candlestick charts are minimized with the help of Heikin-Ashi candlestick chart. But we have to note that this smoothing operation is due to the averaging out of various price levels. This means that the actual price movements will occur around the represented price. So, it is similar to how a moving average functions. But the smoothing effect of a moving average depends on its look-back period. For example, a 20 moving average takes into account the data of 20 previous candles. But the Heikin-Ashi chart does not require a look-back period. So, in that sense, it is much simpler to use and offers more consistent results. But there's a catch. For swing traders and positional traders who trade based on end-of-the-day data, this will not pose a problem. But for day traders who trade in response to the immediate price movements, this might be problematic, as a day trader would have to wait until a candle has been completed. This delay might compromise a day trader's ability to be responsive to the markets. So, if you are a day trader, it is better if you use a combination of these charts for analyzing the market. Now let us learn how to interpret Heikin-Ashi candlestick charts. On normal candlestick charts, we observe the candle body and shadows to find the candlestick patterns. This process involves looking out for various possible patterns on the chart. It could be engulfing patterns, bullish and bearish Mariposus, morning and evening stars, bullish and bearish pin bars, etc. So it can feel overwhelming at times. But when it comes to Heikin-Ashi candlesticks, we can stick to a much simplified analytical process. And trust me, it is very easy to learn. So make sure you learn this properly before proceeding. Due to the reason that Heikin-Ashi candlesticks are calculated based on averages, these candlesticks will have much smaller shadows or wicks than a regular Japanese candlestick. Just like with regular Japanese candlesticks, with a Heikin-Ashi candlestick, the smaller the shadow or wick, the stronger the trend. So the logic remains the same there. Now, green candlesticks in general represent bullish sentiment or a bullish candle. But green candlesticks without a lower shadow shows strong bullish sentiment. This candle is also known as a bullish shaped bottom because the candle actually lacks a lower wick. Similarly, red colored candlesticks in general represent a bearish sentiment or a bearish candle, but red candlesticks without an upper shadow show strongly bearish sentiment. This candle is also known as a bearish shaved head because the candle lacks an upper wick. Now these shaved Heikin-Ashi candlesticks represent increased price momentum. Now coming to the last type of candles, these are dojis or spinning tops with substantial upper and lower shadows, which indicates a neutral bias. It may either represent a possible price congestion or a reversal. Now except for dojis or spinning tops, all the other Heikin-Ashi candles have a very straightforward interpretation. This takes an enormous burden of a trader as you don't have to buy out a lot of candlestick patterns. So with this information of Heikin-Ashi candles, we can figure out two things: the trend direction and the trend strength. Now using Heikin-Ashi to identify trend direction is quite easy. As mentioned earlier, the Heikin-Ashi chart shows you the direction of a trend through its color-coded candles. So a green candle is telling you that the trend is up and a red candle is telling you that the trend is down. Now in order to identify the strength of a trend using Heikin-Ashi candles, you need to observe the shadows or wicks of the candles. So if you notice that for many green candles, there is no lower wick or shadow, and for many red candles, there are no upper wick or shadows. What this implies is that these candlesticks do not show a shadow in the opposite direction of the trend. So if it is an uptrend, there is no downside shadow, and vice versa for a downtrend, there is no upside shadow or wick. So when there is no shadow or wick in the opposite direction of trend, this means you are in a strong trend. So the main thing that you need to look out for on Heikin-Ashi chart to determine the trend strength is shadowless or wickless candles on one end, which is opposite to the trend direction. Now, as mentioned earlier, these candlesticks that have no shadow or wick on one end are also called as shaved candles. That is, if there is no lower shadow or wick, the candle is called as a shaved bottom, and if there is no upper shadow or wick, the candle is called as a shaved head. Now let's take some example to understand these thumb rules as to how to use these candles to our benefit while trading. We have already talked about this in the previous section, but this revision will help you forge the rules in your mind. So rule number 1 is that green candlesticks signal an uptrend. So when Heikin-Ashi candles changes from red to green, it is a sign that the price might be about to head higher. And if you are currently in a short position, you may want to exit. And if you're currently in a long position, you may want to add more to your positions depending on your risk appetite. Second rule is that green candlesticks with no lower shadow or wick indicate a strong uptrend. So when prices are trending up and you find consecutive bullish Heikin-Ashi candlesticks with no lower shadows, then you are possibly witnessing a strong uptrend. You have to stay in the long position until the Heikin-Ashi candlestick changes color from green to red, and ride the uptrend as long as no lower shadows appear and let your profits accumulate. Now rule number 3 is that red candlesticks signal a downtrend. So when Heikin-Ashi candle changes from green to red, it is a sign that price might be about to turn lower. So if you are currently in a long position, you may want to exit that position, and if you are currently in a short position, you may want to consider adding more to your position with respect to your risk appetite. Rule 4 is that red candlesticks with no upper shadow or wick indicate a strong downtrend. So when prices are trending down, and if you see consecutive bearish Heikin-Ashi candlesticks with no upper shadows, then you are possibly witnessing a strong downtrend. you have to stay in the short position until the Heikin-Ashi candlestick changes color from red to green, or you can just stay short and ride the downtrend as long as no upper shadows appear and let your profits accumulate. Now the final rule, or rule number 5, is that candlesticks with small bodies showing upper and lower shadows indicates a possible trend reversal or a trend pause. These are indecision candlesticks. Doji-like candles with both upper and lower shadows are possible turning points or reversal points, or the dojis for spinning tops could even appear during a price congestion or trend pullback areas where the price momentum is weak, and further the price might continue in the previous trend direction. So either way, confirmations are required before considering a trend reversal signal. So with that, we have covered all the basic stuff related to Heikin-Ashi in this first part, and I think you now have a fair understanding on how to read Heikin-Ashi charts. So in the next part, we will apply what we have learned and learn some simple and effective Heikin-Ashi strategies. But before that, if you find this video useful, please like this video, comment and